Welcome, everybody, to a live session of Me Plus Ultra. Special guest with us, John Garcia from Silico Capital. First off, I have to acknowledge why we're late. On my end, it was as simple as unplugging and plugging back in for my audio to take. John and I were sitting there talking for 14 minutes. I can't hear him. So I'm like, what the heck's going on here? So I apologize for that. Normally, that doesn't happen, but it happened this time. So we're going live now. Everything's set. Before we start, some important things I have to say, because I want to get to some of these disclaimers because of our topic today with alternative investments. I want to get this say this up front. John and I met right out of the gate. He buys a ticket for him and one of his partners at Silico to attend one of our business bourbon and cigar events, and I think the first one he attended was back in Scottsdale a few years ago. Great meeting him. I at that point start putting, I meet John. I start seeing some of the stuff that they're offering, and I start putting some money into some of their funds. And I want to make this very clear up front. I never take mailbox money. That's not who I am. So no mailbox money. I take no fee. I take no cut of whatever John does. I get nothing, all right, other than a thank you if people join on with him. I've referred them, and I'm telling you all this because I don't want people to catch this secondhand down the way, and I want to be very upfront with this. I will say that, later after John spent a couple times coming back to Business Bourbon and Cigars, he now sponsors our event as well. So money's going both directions here. I'm giving him money. He's giving me money back. But it's been a great partnership. And more importantly, I don't consider him just a business partner, but a good friend as well. So having said that, the reason I wanted him on this live stream is some of you may know I've had multiple dealerships. I exited out of two of my Honda stores, have one remaining. And, I got all this cash, all right? And I think the multiple we sold them for was anywhere from 6.5 to 7. And all of a sudden, so, in theory, that should last, and I should be about the same 6.5 to 7 years from now, right? That would have been the equivalent of making that money for another 6.5 to 7 years. But I'm sitting here thinking to myself, well, heck, the cash flow from those businesses operated at a pretty good percentage, of the money coming in from the profits every year. I can sit back and try to retire based on selling those, and after 7 years, 8 years, 9 years, 10 years, whatever, if I'm living the same lifestyle that I have, maybe not be as well off as I am today, right? And so I wanted to find something that I could invest in outside of, like, just say real estate or the normal stuff you see in the stock market, where I could get a similar rate of return. And that's where alternative investments came in. And that's kind of what I want to get back at today. So a couple of things real quick disclaimer. I want to make sure I get this right, so I'm actually going to read this one. This is an educational conversation, right? Nothing said today is advice, all right? So having got that out, not investment advice, not legal advice, not tax advice. We're not recommending anything. We're not selling you anything. Once your money goes into one of these, you usually can get it back out in a few years, normally 5 to 7. And let's be honest, sometimes you could lose all of it, right? If you're thinking about doing something specific, ask your own accountant, your own attorney first. Having said that, that has to be one of the worst intros for a guest, saying all that bad stuff out of the gate. But John, welcome to Me Plus Ultra live session.
Thanks, Scott. Thank you. Yep.
How'd you like that intro?
Yeah, no, it's great. You gotta kick things off with compliance. That's always the way to do it,
Well, I didn't want to sit there and, have people come back all saying, well, you told us to invest in this and that and all this other stuff and want to knock that out of the way. But I have to say, without the shadow of a doubt, this is something I believe more people need to know about. More importantly, and the reason I say that is most of the businesses that we can invest in are usually publicly held companies, right? And that's the standard way with stocks. And then you've got the real estate type of investments. But the reality is most businesses out there aren't public companies. So you have to find these opportunities through firms like yourself. And so let me just start off. So let's take somebody else right here. Somebody sells a company. Somebody maybe spent 15 years developing some type of equity and they earned their stock, so to speak. Either way, now they're sitting on real cash, right? Before we get into any of this, why should either of them, any of these people that are sitting on this type of money, look past stocks or real estate? Don't give us a sales pitch. Give us the real reasons. What never gets shown to them if they don't go out looking or if they don't have the right network that can introduce them to the right people.
And by stocks, I'm assuming you mean like the S&P 500 and
Correct.
traditional,
Yep.
right?
Yep.
Publicly traded, we'll
Yep.
call it traditional stocks.
New York Stock Exchange stuff.
Sure.
Yeah. Yeah.
NASDAQ, et cetera.
That's right.
So alternatives have become, a hot category, so to speak. And have had a really good run. You've got different types of investments and equities and or debt positions that you can get within that, the alternative bucket, we'll call it. That could be anything from like a blue chip stock, pre-IPO, some SpaceX, before their IPO. There's some other blue chip like Databricks, companies like that you have to either get access to an allocation. And so with those, in my view, again, this is not advice. This is my opinion. For me, if I were, as I look, I make sure that I'm careful on the access chain, right? What I'll call the access chain or the chain of custody, for the stock, because, many times if you're going to the blue chip alternatives, people are setting up multiple special purpose vehicles, which these are vehicles to where that special purpose vehicle will go out and buy stock, get access to a SpaceX or a Databricks and have the direct ownership in that SPV. And then that SPV could meet someone else and they go, ooh, I want to sell some of that. So then they make another SPV, right? So you can have multiple hops and compound fees that one should be aware of and careful of if you're getting access to what I would consider the blue chip, the blue chip stocks. Even if you're getting access through some of the bigger wirehouses and or wealth management companies, many times, there can be significant fees in those. So that's something important to consider. Now, that said, even with the heavy fees, one can make good money. And so
John, let me ask you this question on those fees. What's a simple way for someone listening, if they got introduced to the right people and they may have a good opportunity, is it as simple as saying what are all the fee structures? But what specifically should they really be asking for to make sure they get all the right info?
Sure. Getting at what I would consider an end-to-end perspective and just saying, hey, who owns the actual equity in the company? Like, where is that held is the first question. And then what are the fees? And are there any other fees outside of this vehicle? Those would be the three questions that there's some, what I would consider intelligent redundancy there. What are the fees outside of this vehicle, if any? Question number one. Question number two, where is the stock actually held? Is it owned by this SPV I'm investing in? Or is there another SPV it's held in? And if so,
SVP, just in case someone doesn't know.
that's special purpose vehicle.
Yeah. Okay.
SPV or entity. entity, those names too. And that's inherent in this industry. A lot of people, now there are terms of art and very sophisticated financial instruments. That said, many people will throw around acronyms and a lot of vocabulary intending to confuse and or impress people. And so they're usually, to Scott's point, is a very basic and simple answer. So an SPV is just the entity that owns the stuff.
I ask a lot of stupid questions.
Yeah.
I'm not afraid to
we'll call them basic in general. But that said, you should be able to boil things down. We have really advanced. I'm honored to work alongside some of the people, and we'll jump on calls and investors, with our LPs, and the people across the table will say, and be like, what, and I love some of the more sophisticated people in our team will be like, what did you just say? It sounded like you tried to say this. Is that accurate? And then they'll be like, well yes. Right. So that is out there. So don't be afraid to ask a question. There is no dumb clarifying question, especially if you're moving money. So, but to go back to your original question, Scott, on like the alternative bucket. So there's the blue chip alternatives, right? There's alternatives it's anything that's not, it depends, go look up your definition. I'll give you kind of alternative investments according to me, right? How I define them are anything that's not a public security that's the S&P 500 or something like that. That's bought on, that's a private placement. So that could be a real estate investment. It could be an investment in a privately held company. It could be an investment in a privately held fund that deploys, debt capital. It could be investing in and or buying paper, buying notes. That can be a alternative investment. So
go into some detail on that.
Okay, yeah. So I would say
the reason I ask is because I think when most people think of alternative investments, they've got this. If they know anything about them, the one thing they think of is, all right, I'm buying into a fund that's got multiple companies in it, where I guess the firm I'm buying, or the private equity firm that I'm buying have this opportunity to buy from or invest in. They own a certain percentage of these companies, and at some point there's going to be an exit, usually 5, 7, sometimes 10 years down the road. I'll get into that in a second. And I think that's where that's the tunnel vision when they hear alternative investment. So you just brought up a couple other things that are outside that scope, and I just want to make sure everybody fully understands them.
Sure. So again, there's a myriad of alternative investments, alternative investment buckets, and secondaries. They're these markets that have emerged, and people have done really well. You see great returns, and then you'll see a lot of packaging and emulating of where great returns were made, marketed that may not have the efficiency and or the value that one's looking for, right? So not to beat on the big companies, but you're either focusing on the asset or assets. The way I look at an investment is like, what is the asset that's delivering the return? How close am I to this asset? And then how is this asset, how diversified, or what's the risk factor with this asset? For instance, I see a lot of, in the real estate world, let's go multifamily, the way that's usually a project by project. So you'll have a company, a large asset manager, let's say they have billions of assets under management. Many times they're pitching this asset or this one project. So you as a limited partner, you're investing, and your money is not spread across. They're not guaranteeing. Sometimes they may, but most of the time, the norm is not that they're guaranteeing your return across a general corporate guarantee, or they're not providing you risk mitigation across your entire portfolio. It's asset specific, right? So this one unit or this one project that has however many units in it, that's what and they show you their past performance on other previous units, and there's a different ownership stack in those. You're betting on what's normal whether it's a fund or whether it's an asset manager, is they're pitching you on their past performance, saying, look how well we've done in this space with these types of assets before. And then this is what we have planned for this specific asset, right? And all the analytics are there. That's in general what you're looking at with alternative investments. And then if you're looking at a fund, sometimes they'll combine multiple assets to spread you across, so diversify you, give you less risk in one specific asset and more chance for success with, spreading your position across multiple assets. Now with that, then you look for efficiency. What are the fees and efficiency for that work being done, for that management being done? And then what's the quality of each asset within that portfolio that you're investing in? And then, what are the terms and conditions, and where does your money sit in terms of preference on return, in terms of position, for equity in both an upside and downside scenario? And where does the manager make their money, and what are their fees? What are the management fees? And do they get paid only if you get paid, or do they get paid regardless, right? And so not one is necessarily better than the other. There are plenty of funds out there where the managers, it's a typical, what we call a 2 and 20 model, where they're taking 2% regardless of performance for managing the money, and then they get 20% of the upside after some sort of hurdle goes back to the investors. There are a lot of people that perform really well with that. That said, a lot of investors doesn't sit well with them for the managers getting paid, whether they perform or not, right? And so I'll pause there. How am I doing, Scott?
You're fine. You're smarter about this than I am. So I'm just here to ask you good questions. Hopefully it helps the people listening. So, and by the way, I got this thing scrolling at the bottom. Got a question? Ask us in the comments. Some of the comment, depending on what platform, what social platform they're on, some will come through to, I'm using StreamYard to get this out to all the different social channels. So some will come through to me. If I see a question in there, I'll try and get it on air to you, John, so we can answer it live. We may have to go back on some of these channels and answer people
Post interview
after the fact. Yeah, after the interview. But so if you guys have questions, bring them on, and we'll ask. And I guess here's a question by David Boyle. In the PE space, is there a hot segment right now?
Yeah. So PE. So if you're talking about alternative investment space, yes, there are multiple hot segments. If you're talking about the private equity space, yes. So private equity to many is, small, middle market, and even large companies, but it's cash flowing business that's more mature, that has EBITDA that's been in business for a while, that's more of a mature business. It's not your startup or your or your earlier stage companies. So that in the private equity space, it generally speaks to a more mature business plan, business model. And so AI is really hot right now. If I go just flipping over and just answer for the alternative investment category, AI is super hot. My thoughts there. There's some incredibly valuable companies in that AI space that will deliver huge returns. There are also companies that are inflated in value, similar to the .com bust. If you want to go back to the late 90s, early 2000s, then there have been these booms and busts with companies. It doesn't mean that the companies aren't valuable. It means that they can be overvalued. So I think that there may be some of that going on, and it's, you're trying to figure out who are the winners and who are the long-term value providers. Kind of take the Warren Buffett view on those companies, who's going to be around in the future, helping define the way business is done. Those are typically the ones, to jump in on, and you're looking at the multiple and are you getting in at a good time? I think that, the deep tech companies, to me, so if I'm going to go across now kind of alternatives spanning into the private equity, and just because you're in this category doesn't mean you've got a great company. Let me hit that hard. Okay.
Yep.
So I think there's an arms race, for compute, for AI, for across the world. And so what that's driving up is data storage, both hot and cold data storage tech. You've seen Western Digital and some companies like that really, grow quickly because of supply and demand for the cold storage. I think there's some burgeoning companies there with new tech. I think there are companies that supply and demand is really in your favor for, some of the companies in that space. Energy is a hot place to be. If you find a company doing with a competitive advantage, or, just look at data centers and a lot of the hyperscaling. And then you look, so within that, construction companies. I know I was talking to a construction company in the Midwest. They were doing 1 to 2 billion a year. And that's a strong clip. That's one of the top in this, one of the top construction firms in the Midwest. They're on track to do 17 billion this year, largely because of the hyperscaling with the data centers. So that's, there are these kind of offshoots in the PE space. To now keep in mind with one of those, they're building for a tier one company, 8 billion in 24 months is what they'll realize. I'm talking about a general contractor in this case, a construction company that has deep experience, over a decade of experience building data centers. And so I think, with this, when you see AI, you don't have to necessarily invest in the AI company. It can be, what those companies, what compute drives. So you're looking at energy, you're looking at, the right type of construction firm. You're looking at, semiconductor companies, obviously. You're looking at, storage and compute, anything that supports compute. And then in some case, and then the space race continues to be really interesting when you look at the real estate and what's involved from the arms race of the compute power. That's what's driving a lot of the SpaceX value in my view is if they can get the data storage in the data centers figured out, orbiting, out there in space. I think that can be super valuable and really interesting. And then AI is also a tectonic shift, in my view, across the entire market. It's displacing a lot of employment and it's creating a lot of new and innovative ways in the market space. So I think we're lucky to live at this point in time. And it's really interesting to see, I was just, kind of riffing there on just some of the ripples and what's going on. And I think it's smart to, play into it and to get your investments timed and sized right to where if you're playing the long game, be clear on what you're doing. If you're moving in and moving out, make sure that, you've got that 3 to 5 year horizon or that 1 year to 3 year horizon that you're looking at.
Let me hit you between the eyes with a couple of things real quick. So to me, somebody's going to invest in some type of alternative investment because they believe, whether it's 3 years, 5 years, 7 years, 10 years, that they can earn more than if they doing something safer, like say real estate, some type of multifamily, or something in, with the stock market, right? With the publicly held companies, publicly traded companies. And so my question's this: obviously, anytime you do something, there's a trade-off, right? So if I'm sitting here and I've got, I'm going after this higher return, the trade-off is it's usually riskier. Fair to say?
Yeah.
There's no such thing as super high return, super high security, right? It just, if everybody knew, if that was the case, everybody would invest there. So my question is this, because right now, alternative investing in some circles is getting some heat. And the heat is coming from places like saying there are people, and I've got an analogy, I'll come back to it, but I want to hear your answer first. where it's not easy right now to exit out of companies. Or some of them, there seems to be a backlog, and there's a lot of companies that are not being sold. And obviously, if you're in some type of investment like this, that's pretty important, is it not? So talk to me a little bit about that. What's fueling that? First off, is that even accurate to say? And then what's fueling that?
So return and access are two things that so return can describe risk, and it should. However, big however, for instance, like the return on building a data center in a 24-month period of time, depending on how it's underwritten and which part of that return is being underwritten, can be relatively low risk. It's just understanding what you're investing in well. And so that would point to access. So why me, right? And so those are all good questions to ask. And as long as there are good answers, for those, I think risk is the ability to predict an outcome, right? That's risk is in the investment context over a period of time. And then what's the risk of losing the principal? What's the risk of getting the return? And what's the risk on the timing? That's how I like to distill risk is, again, risk is my principal at risk, and risk in what way? Risk in never getting it back, risk in getting stuck for longer than I anticipated. And then same thing with a return, per unit, per unit principal. Am I going to get the return that was shown to me in this pro forma or this forecast? Is it going to get cut, or am I going to get it at all? And what's the timing in which I'll get it, right?
I brought up the ability to exit these companies is critical because, for instance, the normal person gets out there, and if they have an opportunity to get into some type of alternative investment, let's say it's a fund that specializes in, hey, we want to find a bunch of disruptive type companies in a specific industry. That's our niche, so to speak, right? Let's say that firm that's their niche. I'm speaking from experience here, but I will not name. This is not you all. This is for you guys. And typical stuff. We plan to exit and start exiting these companies in 5 years, but within 7 years, you can expect 3, 4, 5 times whatever the number might be. And I'm trying to be somewhat of a window here.
I get the risk profile that you're trying to.
And so, but here's the other thing, other than the fees that you talked about. We get to year 7, and within our right, now we're going to year 8. We get to year 8, now within our right, now we're going to year 9. And now we're going to go to 10, and it looks like in the end, the money might double. There's a real world here, okay?
Okay.
And I had a conversation with the fund manager, and I'm like, wow, this is horrible. This is not a good return at all. It sucks. I have no problem saying that on here. And I got to hear, well, no, sucks would have been if you lost all your money. You'll double. You're doing good. I said, yeah, double in 10 years. You're not factoring in the opportunity cost that money could have done somewhere else. So in other words, I could have put it into a much more secure investment, netted the same, if not more. You following where I'm going with that? So in addition to the fees, what are you really signing up for, and what would you advise without giving advice? What are things that educate us on over and above the fees? What else is there we've got to look for? And then I want to come back to the importance of being able to exit companies. So I want to have a conversation on that.
Exit companies or exit the investment?
Exit. Well, I think the investment, if we're talking about a fund that has equity in multiple companies, the ability of that, who's managing that, to be able to get these companies into an exit situation and get them sold. Because in the end, that's the only way any of the investors are getting paid.
Yeah. So I think it's, to your point, Scott, I think it's important to understand liquidity levers, right? Liquidity levers or options. So in depending on the strategy of what you're investing in, if it's a fund, what you're describing, I'm not exactly sure. By the shape of what you're describing, I have an idea, I think, of one of these, 5 to 10 year early stage funds that are moonshot companies. And then, there's portfolio theory. There's the power law. If you want to look things up, there's portfolio theory, which is the way that a lot of these funds will deploy capital across multiple companies. And there's the power law. The power law is, one company could give you an incredible return, right? And so they play this, and then they show you the plans, and early on it looks great. There's trajectory and so on. The world's the world, and there's risk in everything. So I think if you're depending on an exit of a company, right, on an exit of a company to happen, just thinking through the logical basic cycle time and where they truly are in the arc of this company, right? And so now there are anomalies, and that's the power law part that'll factor into these things. And you're betting, you're looking at that manager and so on. But for me, what I look at is, best laid plans, right? Analysts can make things sound like, how can that fail? And then you jump in, and then something very basic and simple happens. You're like, oh, right, that. Forgot about that dynamic, and a war broke out, or, oh yeah, a pandemic, or these different factors, and that how resilient is that company, and what are you actually depending on for the monetization to happen is the quick of it. So if I invest my money, do I need this company to exit, to have an investment banker take it to market it, sell it, money comes in, then money gets distributed. Just that alone, the sale of these companies sometimes can, that can take it a significant period of time. And then getting that company to the point where the market will react, or a strategic will react to buying that company, and then just think of M&A process and how that can work. So that's a good way to think about these things. Now, anomalies happen. We had a company that we did not underwrite to. We thought, we work backwards from a 3 to 5 year strategy to deliver, 8 to 10x to investors net of fees. That's a key part of a strategy of a couple funds that we've launched. We had one of them that, was going to hit its 8 to 10 mark 4 years down the road, jumped up, and in 2 years, it's going to deliver 97x. I would love to tell you that we had that planned. We did not have that planned. And that was a bunch of fast moving transactional stuff that's rare. Now we put ourselves in an environment to where those things can happen. And so that's what I would tell you to look at is look at what the strategy is that is asset specific. And then is that an environment that where this power law stuff, these big wins can happen, and then invest appropriately, size your money to the longest term that is in there, and or not returning. So to Scott's point, if you listen to that manager, he said you're lucky to get your money back in the whatever strategy that was, right?
No, well, he didn't say I was lucky. That would have made it. He said bad would have been losing all your money. He goes, you'll be doubling your money, which is a good investment. But I'm thinking doubling in 10 years. Well, there was a lot more secure investments I could have made that would have got me that. That's not a good investment to me, because there's an opportunity loss there too over that 10 year.
Yeah, I get that. So I'll phrase that better. Sorry. Good point. He said bad would have been losing your money. So there was an opportunity for you to lose your money because of the profile of that, the mention of it. You've doubled your money in a 10-year period of time, which is 10% a year, give or take, right? And so now you're getting it at a slug. It is long-term capital gains. They're all of those factors that I would be assessing that I am assessing. Not giving advice, but
I look at the net.
Yeah. Yep. And so I guess, Scott, if you're looking at these things, it's now there's secondaries. Where I was headed is if there are companies and today there's secondaries markets, and if you see that as part of a strategy, to me that's a positive. in two ways. If a company is if you've got an earlier stage company, or you've got kind of that J curve that you're looking at. So the J curve can take anywhere from 7 to 10 years. Sometimes other companies have strategies where they'll try to catch it right before the J curve, get a 3 to 5 year strategy in. But that said, if you're on the J curve strategy, what I look for is along the way, if those companies are truly on their way there can be secondaries opportunity where you may not exit at a 100x or 50x or a 30x, but you may be able to exit at a 3 or a 5x and do it earlier, so the IRR is better. Kind of to Scott's point, he probably, if the secondary strategy emerges or is part of the strategy if you're looking for those bigger returns, some of the venture returns, I find that as a positive, because that's another liquidity lever. So now you've got two options. It's not just the sale of the company. It's you can engineer an exit by selling your position to a third party that may want an allocation or to get in on that in a period of time that's more attractive. The other thing is to look for, are they going to have distributions? Are they going to be reinvesting their money? A lot of these earlier stage companies will be reinvesting their money for, purely focused on that one, the sale. But other times, if you're in the PE, or if you have a blended strategy that may have some other types of assets, you may get distributions over time that can engineer cash flow into some of your positions. It just, I just look at the monetization strategy and try to be clear, and things often take longer. And then they're forecasted to do. So if you have a strategy that's a 5 to 7 year strategy, a 7 to 10 year strategy, you're looking at 10 to 12, 10 to 15. Mm-hmm. If you're looking at a 3 to 5 year strategy, you might be looking at a 5 to 7. If you're looking at a 5 to 7 year strategy, it might be 10. Now that said, that's not to be confused with the life of a fund. So I would separate those two, because sometimes.
What do you mean by that?
Right. So sometimes if you're looking at a PE or a large allocator or manager, a large, not less boutique but really large, they'll have a fund life where they're mandated to liquidate all the assets no later. When the kind of some of the language you're using, it's within my right. They may have to liquidate sometimes at 7 years, at 10 years, even before the company
is ready,
achieved the value that they want. They may have to sell out. So
that's the downside.
Well, I just want to
having the security and knowing they're going to exit out in a certain amount of time.
Well, I just want to be clear on what you're looking at. So the life of a fund, and the strategy could be two different things. Yeah. You could have a 7-year fund that has a life that's much longer. Just because the life is longer doesn't mean the strategy. It could have a strategy to monetize in the first 2 years or 3 years, but have a 5 to 7 year life. You know what I mean? Just because. Yeah. So I think looking at those nuances is important. There is a relationship between the life of the fund many times and the assets and the strategy, but I think it's important to distinguish between the two of them.
Yeah. It's funny. I love to simplify things, and I'm thinking, going back to, here we are selling cars, right, at Johnson City Honda, and I make my money when I exit, right, when I sell the cars. All right. So if I'm not selling the cars, I'm either a combination of the two or one of these two, and that's, I can't market and sell. I can't market or I can't sell something, right? Or the other thing that happens is I got into the car wrong. Let's say it's a used car. All right. So when you're selling used cars, right, there's two things that happen. You're buying the car, and you're either buying it right, or you overstepped and over allowed, and now you got a bad investment and you can't sell your way out of it, or you're not going to make the money you should. I would imagine for people like yourself, it's not that far different. You're getting into these companies, and you're either getting into them right and setting up the right type of structure, which I would assume makes it easier to get the return you want down the road, assuming the growth happens and the company scales the way you anticipate it to do. Talk to me, but to me, there are funds out there, there are firms out there that just they can't get these companies. Either it's the market and the exits don't come the way they should. Does that make sense? They're not there. There's almost like a surplus and a backlog of companies that are not selling.
Yep. Yeah. So what the question is, how do you have a strategy?
Well, you said you know what you're getting into and getting invested in, but let's face it, right? The normal person this isn't like buying Apple, where I know what Apple's doing, or Google or Amazon or something like that, right? This is probably a fund full of bunch of different companies that I'm going to have limited experience on. So how do I really know? And there's a lot to look at, right? You got the fee structure, you get the terms, you got the life of the policy, and now you got all these companies within it. Is this a good investment or not? Like, what's the best? Educate us on what's this? I mean, is it as simple as turning it over to somebody that actually knows what the heck they're doing and have them look at it?
Yeah, I got you. So I think I get your question now. So yeah, I think so. If you use the car dealership analogy for EV, I'm gonna pick on EV for a second. EV and then emission, depending on which way. There are a bunch of things that we think we know, right? So I know that. So EV was hot for a second because of the incentives, because of the efficiency, because of
they were never hot. Those backlog too.
I'll throw Tesla at you.
They're hotter on the used car market than they are the.
See, these are things that you know. So there's the EV, and so just depending on how the policies work, how the market works, you've got charging infrastructure, things that are available, things that aren't available. You've got Tesla being this huge brand mover, right? That came out with EV and was just, is an anomaly in a way on the EV space. And then you had the big automakers that weren't Tesla try to follow them into the EV space and did all these metrics and all these things. And it looked like they were going to kill it. And then they didn't, right? Many of them didn't. Some of them did in certain categories. Many of them didn't. That's a good example of, but it's a new space. You know what I mean? It's something new that's happening. You're jumping on now is that new space going to disrupt the current space, right? They had all these analysts that were talking about these things. You got to hurry up. And I'm sure you were affected. I'm sure Johnson City, you had to install an EV charger or two out there, maybe, which you guys laugh at times. And so that goes to the knowledge of the market. There's still a glide path. Even if EV was going to come in and disrupt, now it's easy to say hindsight looking back. Other people were like, oh man, are they going to make the gas cars anymore? And so they're like, yeah, of course, there's this huge glide path of the gas cars. Then there's hybrids and people are still, doing all these analytics on which ways are things going to go. So to me, what you look for is you get an expert and you look at a 3 to 5 year piece of time. And if you're talking about big market changes, there's going to be a stream in there of these folks that just know what's going on. And if there's that there's the bell curve and what's coming down the center of the bell curve. And again, anything can change, but I think that hit COVID, that changed the bell curve straight down the middle of it. But if you're looking down, what I look for are, where do you find where all three strategies, if there's the kind of the outlier strategies, the innovation, the new stuff, where can it align with the bell curve, the straight down the middle? No matter what happens in that space, you're going to make some money in 3 to 5 years because you're diversified across those different strategies. That could be like the tried and true cars that move in that market. You've got some new and innovative stuff. You have access to it if you need it. You can participate. And then you've got a period of time to where you can throttle up and down within the marketplace. Strategies that are designed like that with a manager, and that really speaks to somebody who knows what they're doing, that can engineer those returns, and balance the value. I think that you've got something special there. And so that's what I look for, is the best of the commercially proven mixed with innovative, that has strong data, and that whichever way you go, you're going to make some money. It's just how much. That's what I'm looking for.
When you guys are looking at making a significant investment in a company, what's the top 2 or 3 things you're really paying attention to?
So, scars gained over time. I was looking at my picture that you marketed there, and how my hair and my stature has changed a little bit. This is well earned. This is here comes what I think are the value pieces. So, what I'm so your question, what I'm looking for is, I guess, strategically, capital efficiency, right? So making sure, like, how capital efficient is something. What is the time, that what I was talking about, the time frame to returns, the moat, like, so what period of time, either whether it's a market or whether it's a company or a technology, what period of time, if competitors come in, is there enough business to where, both are going to do, like, what's the moat, what's the value, and what's the efficiency, right? And so capital efficiency, you go one layer deeper, you're looking at labor. How much do I have to depend on human labor? For instance, I'll talk about some of the stuff that we've gotten into, where we jumped into things that would be cash flow engines, right? The QSR space, we jumped into that, and partnered, tested, went out, killed it on the test. The pilot companies printing money, decided to scale, and then COVID hits, right? That changed a lot of things, and beyond that, but we had planned for recession and global. Now COVID's quite a bit different than those, but through that lens and looking at it, we could have leaned in and made money, but the operating, like, this is what I'm talking about, capital efficiency, the money that we would have to put to work there and leave there, the time and the street fight, and by street fight, I mean just be in there in the grind every day. That opportunity, this is a long-winded way of saying opportunity cost of team, time, resource, and focus, to us, not worth it. So we ended up, divesting. I always would watch companies and be like, why would they divest of assets that can make money? That's dumb. And here we are doing it, because that's really a mark of, in my view, of success, when your opportunity cost outweighs some of the strategies and some of the capital put into these things. And then being kind to, like, our investor group, you got to be kind to the investors too. Like, so if they followed you into that strategy, you're putting them in something else if you're choosing to wind something down that can make money. Yeah. Because your choice is opportunity cost. That to me is the best way to screw things up and have a great company. Meaning that you're weighing the opportunity costs versus just a flat out dumpster fire, which also happened. But then you got to make sure that that's controlled. The blast radius for anything is controlled. So if you're asking, what do I look for and how do I mitigate risk? It's, I look for capital efficiency. I look for, we leg into investments and making sure the exposure is diversified strategically. So the best chance of success, broad enough, deep enough. And then we're committed to the core, where we have our strong suits that I was talking about earlier. The innovative meets the core, and stay disciplined, focusing on those. And if we're going to go broader, be ready to let some of that broad stuff go and or prune to make sure that you've got the kind of your center position figured out, and to know who you are within that. And it's not easy to make those decisions sometimes, but it's key, I feel like. So I don't know if that answered your question.
It does. What I love about alternative investing, and I'm not sitting there, obviously I don't I didn't put everything I had into that because that would be foolish. I feel like you mentioned diversity. I feel like people need to, it's probably wise to be pretty diverse in your investments as well. And but I love about alternative investments are the creativity. Like, all right. And when you got the right ecosystem and you're in the right rooms, you're sitting there and you're like, well, I've got this situation, I've got this tax situation that's going to be hitting me this year or coming up, and all of a sudden you've got this guy who knows this guy, and things start blending together. I don't want to sell, I don't want to go into a pitch, but some good tax strategy has come out of it from various investments. We've spent a lot of time kind of in this world of like, all right, here's a fund that has multiple companies in it from an equity standpoint, but there are also alternative investments where you're getting paid back every month. And let's spend a little bit financing debt. Talk to us a little bit about some of that type of stuff. And by the way, when you're getting a check back every month, that kind of feels, almost safer than the stock market because you're getting it back, right? You're getting it back. But which part of that monthly check is riskier than it looks?
Great point, Scott. So people engineer.
And by the way, are you good on time?
Yeah, I'm good.
Okay,
I'm good
okay.
on time. So I got another what are we at?
We're whatever you want to do.
Okay, all right.
As long as you'll keep me, as long as you have time to keep answering questions, I'll keep asking them.
Okay, gotcha. So okay, yeah, let's go for another 25. Is that cool, Scott?
Yeah.
I can do that. All right. So and although this is a live stream, you can edit this down to hopefully get some efficient pieces. Right. So 80-20, right? So the 80-20 rule. If you look in your
let me go back to the question. So my question was, let's just talk the debt one, right? Because those are some where you might be getting checks back on a monthly basis. They feel safer, but what's the riskier play to that?
I got you. So
which riskier than it kind of looks?
Does getting monthly payments speak to the actual risk that's behind it, right?
Yeah.
So yes and no. So I'll opine on credit in general. Again, this is not investment advice, and consult the market and your trusted advisors.
Yeah.
So private credit it's a hot place to be because it provides liquidity, right? Cash flow, which is very attractive, and it can do so at attractive rates. Outsized market returns.
So speak to the person that may not know what we're talking about here. The opportunity for them is to do what, and that does this, like fill in those blanks.
To invest in providing private credit, which is a fancy way of, or not even fancy, but it's a way of saying provide debt to companies or different positions in the marketplace.
So if I'm doing this with you, I might be sitting there saying, all right, I'm going to give you this. You're basically saying this is a debt. You're basically helping us provide credit, but you're distributing the credit to whatever company you need to. I'm not sitting there telling you, yeah, I'm giving credit or paying the debt for this. Right. That's where I'm getting at. I want to make sure people fully understand this.
Yeah. So you are and you aren't, right? So depending on how the deal's underwritten and how your investment vehicle works. So some people get involved in private credit by investing equity in a debt fund, right? Or very similar, you could get into the real estate. There are real estate deals that are a lot of funding, kind of pre-construction deals, right? So you'll fund, you get some sort of accrued preferred return and or interest payment, and then at the refi you're supposed to get your money back, and then you have a position. More pure play private credit is it could be lending to real estate, it could be lending to business, it could be lending to, it depends on the position. That's important to research where the money's going and what's backing the returns. And I look at three things. I look at, is my principal at risk? What's the asset coverage? If everything were to go really bad and they had to liquidate all of these assets, is there enough there to cover, whatever their debt obligations are, including my principal back to me? And so looking at that, that's a key thing I look for. That's the risk part. Now, my money could get tied up there if they go BK, if they get, and just a fire sale happens, how much of my money is going to come back and how long is it going to be in there? That's the first thing I look at. Number two, when speaking to risk with the cash flow, and then, does it pay monthly? Does it pay quarterly? Does it pay annually? Right? Does it pay semi-annually? These are questions. This to me doesn't necessarily speak to risk. This is what the marketing and the mechanism is designed to do from a meeting the market and engineering for liquidity. Obviously, monthly is more attractive than quarterly, is more attractive than annually for some people. Now, from a tax standpoint, some people prefer to put tax into the future and not to get too far into the weeds. You can get some really interesting structures to where you can get long-term cap gains, not by investing debt, but by investing in equity that provides preferred returns and feels very similar to debt, where the principal can come back. And so then what's the timing? Like, what's behind the liquidity? What's providing the liquidity for the returns? That's another dimension of risk. Is what's the performance necessary for that amount of return to happen? And what are the terms and conditions? Is that return guaranteed, or is it a range of, or is there a range of return? Am I getting a portion of, is it a sliding scale? So they're debt notes that pay, they guarantee you're going to get 8%, you're going to get 10%, you're going to get 15%, you're going to get 20%.
And they're all over the board in terms of the percentage and the length, correct?
Correct. And so what are you going to get? And then what's paying those returns? How frequently are you getting them? And what's your risk? And so often as the rates go higher, the risk increases. And then what type of risk? Is it the risk of losing your principal? Is it the risk of the return getting cut and not paid? Or is it timing risk for the monthly or quarterly payments or annual payments? Or is it risk in general? Right. And so looking into that, it's what's the asset coverage? What's the ratio? All of those things are pretty straightforward to look at. And then now if you look at the private credit market was hit pretty hard. And then you got redemption schedules too. You saw a lot of the huge asset managers, Apollo, some of them, like, basically they were providing liquidity to where you could put your money in for private credit and then, get these, some pretty strong returns, but then be able to call your principal back. And if there's a run on the bank, or if there's too many people redeeming, that really punishes the private credit equilibrium. And so you got some of the leading thinkers, some of the biggest asset managers, and what they were showing was private credit was actually performing well. What got out of whack was really the liquidity per unit time. And if the investors decided to be more patient, leave their money in longer, and rather than raking it out, a lot of the private credit positions were actually very stable. What was off was the liquidity timing. Now, big funds and big industry and placements don't like that, and they'll flex and pull their stuff. So depending on where and now if you have a boutique manager that you're placing private credit with, sometimes they can perform in different ways, and it's a different experience, right? So the larger you go, the more institutional experience that you have. And so if you lose, you lose. If you win, you win. And with some of the boutique things, what you have to be careful of is they can feign, having really strong backing. And then, they may not have the assets that they're describing. And so I would look for transparency, good feel, what are the people doing? How long have they been around? All of these qualitative factors for risk become important, when you're looking for a partner that you're going to invest your money with. And with all of that, checking out. Do you know people that have worked with them? How references? Do they have references they can give you? In addition to the returns, because some of the biggest allocators, they can lose your money. Like it's in the paperwork. They can say, oh, that didn't work out. Sorry. I know a deal, Bank of America, Honeywell, JP Morgan.
These are big names.
These are right. They I think this is public knowledge. They syndicated and just wrote something off. It didn't work. And I know a small bank that got, they lost right alongside them. And it seemed like a very tight, it was incredibly well underwritten. It's just a bunch of things that just didn't go right. So depending on now, those same institutions provide super safe stuff you won't, that's really hard to lose money in and so on. It's just make sure that you read your terms and conditions and what you're signing up for. And then, and then if you're going for boutique, I look for big enough, small enough. I want the coverage. I want to know that they have the assets. I want them to be really clear with me on how they manage, and then live within that and have access to where I can get a read of what's going on, if and when I want to. So that's the way that I look at the relationships, and then you get the bigger institutional things. If your relationship leaves, that will you have the same treatment and the same value that's there. So, but then speaking to the liquidity, pointing at risk, a lot of people like to lend and get regular payments, and they look at if those regular payments stop, going back to the private credit situation I was describing.
Yeah.
They look at that as a sign that things are going to, hell in a handbasket, or that things are not going well because payments stop. They look at it as the heartbeat is about to stop. When in case, it can be the opposite. A good manager, when they pull back on liquidity, they could be managing and balancing and stacking returns and making sure that you're going to make all your money and then some, because there are usually penalties and fees if you've got a good deal. If they stop paying, they should be stacking things up for you. And that can be the sign of a good manager, but it's definitely the sign of something that you need to be looking into what's going on. Because with us, our private credit strategies, we often pause liquidity because of the types that we're dealing with illiquid assets. Now, we pay really well when we do that, and the asset coverage is there, but our strategy is pretty unique. If payments that were regular stop, you want to look into what's behind it and what's going on.
We have a question. We have a question from somebody watching us here.
Okay.
A lot of people, including ITR Economics, are calling for a recession, especially with I hate using the R word. I usually don't include it in my vocab. I never participate in them.
Let's call it a correction.
I don't participate in recessions. However, they're calling for a recession, especially with concerns around an IT tech bubble. If you were us, meaning people watching us now, where are the 2 to 3 places you'd put your money right now? What industries would you look at?
Okay. So, great question. What I would say is I think we're in for a huge correction and or shift period. Have been for a while. We pre the credit correction that's finally kind of showed up, we were anticipating that being 2 years out for like 10 years, 8 years. So that being said, I think, if you're speaking to the tech bubble, quote unquote, and more I just like to go straight at where's the safest place to be. To me, it's energy, right? It's going to be energy. It's going to be, with a huge asterisk next to what I'm about to say. So it would be energy. It would be, data storage. It would be compute. That said, within each of those, you got to be careful on where you put yourself, because in any industry, I don't care if I give you 3, if you're in there, you can lose. If you get in the wrong place at the wrong time, you can be in the right category in the wrong company easily, especially because if people are rushing there. And then the right place, that can mean different things to different people. So like the Warren Buffett view, park and be there for 10 years. So I can give you that answer. That I would say is, you're looking at energy companies, great place to be. Energy storage companies, great place to be. And battery, battery tech, the rare earth stuff. I think, but again, you got to be really careful on where you are within that. You got to be with companies that are going to be there and delivering for the long haul. So who are the blue chips within those categories that are going to be there? And so that's a safe place to park. And let me describe safe. Like, you get in at a good rate, things go up or down, you're going to be sitting at a good spot, and a slow trend could be a good trend, but it could be a slow trend up, right?
Let me ask you a question. Is credit markets tighten? I'm not saying they are. I'm just saying if they tighten up, does that make the opportunity to enter that type of investment better? Because I would think there's more companies that have to go outside the normal way to get money, right? I mean, how does that work?
So what's better, right? Artificially inflated returns, to your point. So getting into like a tech stock that jumps, and then you stay there for long enough, and it comes back down, or something you got in and went up and you stayed there, and it kind of like a NVIDIA seems like a kind of a long haul company, right? So that's one where it shot up, and it's gonna. I feel like that's gonna be a player for a while, right? I guess what's better with credit. So credit creates all sorts of opportunities, and in the market, if the market's hot and high, that creates all sorts of opportunities to look for good buys that are outside of that are being, when everybody's rushing like a gold rush to try to make a bunch of money in a short period of time, that leaves kind of longer term positions undervalued. When people are looking for the gold and things that are really safe, that there can be some really good buys when markets adjust on things. I guess it's
what I'm talking to you about in terms of, you mentioned with the alternative investment being the credit side of it, financing debt, right? If I'm making that investment, if I'm giving you money, right, as a debt investment, where I'm offering I'm indirectly offering, I guess, the credit, right? And so, my question to you is, when the traditional credit markets with banks start to tighten
as in prices go up and it's more difficult to get debt.
It's just harder to get the money, right? It's harder to get the money I would assume when it's harder to get the money traditional ways. Now, it's obviously there's a reason for that, and so that raises risk. But at the same time, wouldn't it be? I would assume if someone's going to be making, like, let's say I'm making that investment with you, I'm assuming that my percentage of return would be going up along with that risk, would it not? I mean,
if you're looking at like a market trend, then yes. Like from a general market, if credits, if the baseline, if the low cost money is supply and demand, less available, or it's going up, then
they have to find the money somewhere.
That's right. Then it's going to create more demand and opportunity elsewhere, for sure.
All right. So tell me, where have you been wrong? I'm not talking necessarily about the market, but you. Like, what did you miss, whether it's looking at a company, buying something, or maybe doing some type of thing with debt, any whatever one of these alternative investment buckets, so to speak. What's the biggest mistake you've ever made? And then what have you done moving forward to, I guess,
to avoid that?
To make, you're doing it differently now to avoid that from happening again.
Okay. So at the risk, I'm getting some feedback for some reason. God, I don't know if that's.
I hear nothing on my end.
It just started. Okay. I'll deal with it.
You got the feedback. You got a technical problem on the hard question.
Okay. So sorry, setting off my audit activity here. So where did I? So at the risk of sounding silly, where I had a miss would be one that I knew the risks. QSR, the quick service restaurant world, in two ways, in investing in the actual, three ways, in the model, in the restaurants themselves, and the real estate. So why I would say that is, so we had a vertically integrated approach. Now that's also our strong suit there, so it's fine. It's what I was talking about earlier. Is we thought we could hire for the kind of the gritty operational fight that it takes to scale these businesses. We had a great partner that was a franchisor, growing super fast. It demonstrated how to make money. We tested the pilots, and then we engineered a financial mechanism to give people an opportunity to own something that wouldn't otherwise have it, right? So everything was there: the altruistic piece, the performas, the testing, and then so we started growing, and then we were growing really fast. And so the mistake I made was leaning in and growing too fast. So we had a great model. It was growing quickly, and we just fed it with capital because it made sense. You're fighting for street corners. You're, the different, you get this opportunity, you jump on it, and you keep rolling. And then because of the centralized piece that we're participating in, economies of scale, you start to do really well. And then we ran into this metric that Chick-fil-A, they open up, I think, 2 new Chick-fil-A's a year or something like that per market, or now that's one of the they're incredible, right? I think a lot of that institution, that business, they're not growing slow because they want to. They're growing slow because of how valuable and how important that owner operator is in each store. And so what we were doing, we had, 80-20.
I was shocked earlier when I asked you what are 2-3 things you look at. You didn't bring up the management team running the company.
Yeah. So, well, no, we do. We look at the management team running the company, and we ran our analysis, and everything checked out well.
Yeah.
And so what it ended up happening was that I'm saying the owner operator in each store.
Yep.
And then that mixed with the labor, mixed with the price hike, it became such a battle that, you go to the tribal way of doing things, like these tribal families that'll come in and run things, but then it's fragmented, and you get a lot of, there's just it's a different type of company to run, versus you got the institutional and being able to provide the systems and the process. And then, but the day in, day out, like how tough it is to day in, day out, it's a special breed of person. And there's a reason that these companies slow down, and you get that perfect owner operator. And if you don't have them, you don't open. We thought we could open, and because it was so amazing, we could go find that owner operator and replace them. Not the case. And so now, through all those learnings,
there's not enough good ones.
Well, there is, and you can go get them, but it's just, that's all we would do.
Yeah.
And we're not willing to make the sacrifice. And so what I learned from is recognizing a company where you're going to have to make that sacrifice, meaning that's going to be like you and your team, like us at not below us, not the people we hire, us are going to have to be focused and wrenching on that company in order to make it successful. And it was having the humility to, the amount of muscle that it'll take to make a company like that successful. So that was a miss. And how and why it was a miss, we leg into each company, and we know that, we learn why it was a miss is we legged in, and we went even bigger. Right. So that was like a miss I'll take on the chin was the fact that we started getting these metrics, these benchmarks, and we were like, but we had these success indicators over here that were proven, that we should lean in some more, but just gut feel looking back, in hindsight's 2020, of course, right?
Yeah.
So the combination of COVID, of how that made costs go up, the labor battle, the other industry leaders, in anyway, I'm talking long because it's painful. Thank you, Scott, for bringing that up. But I'll take that one. That was a miss, to lean in as heavy as we did there. But the silver lining in it is, we stayed disciplined with our model, and then we divested and cut, and that feels really good. So
we just got a question from a person that joined us late, looking for when you're looking to buy a company, what are the top 3 things that get your interest, which you've already answered. So just go back into this episode, and I'd say about the halfway point, I think we covered that. And
we can do it real fast. Capital efficiency, having a strategic advantage in a market or an industry, and then I would say that the management team and the confidence and the outcome and the timing of the return.
You got time for a couple more questions?
Mm-hmm.
Tell me no if you don't.
Yeah, I got you.
Okay.
Yeah.
Is there an alternative investment right now that's getting a lot of hype? Like, wow, people seem to be really hot on this type of investment and they shouldn't be? That might be a simple no. I don't know, but.
Is there a is there something where people are rushing it and they're gonna lose?
Well, they're like, wow, have you been doing it? They're talking to their friends, and there's just this buzz around this one type of investment. Like, we've talked mainly about 2, right? We've talked a little bit about the private credit, and we've talked about kind of like the equity, having funds with multiple companies in it where there's equity share in that. So
I would say just be careful and size things well. Size things based on your confidence. So here are the things that we look for. We want to have expertise in how strong are you realistically with being able to look at an asset. So number one, and this kind of goes to that previous question. This is another dimension of answering that question. So how clear are you in being able to understand everything that needs to happen for that to be successful, and working backwards from that deeply and honestly? How qualified are you? Meaning, have you put your hands on a business like that before? And then being a smart follower, right? Number 2 is are you a smart follower? How well do you know the person if you're not that person, which you're probably not, and we're often smart followers too, is how well do you know that person and or that team that you're following into the investment?
Yeah.
How well do you know them? What's their performance, and how close are you in that position, right? So those 2 things are really important. And then size your investment appropriately based on the answer to those 2 questions. Then if you just gut feel, like my wife, I told her not to invest in Tesla years ago. I was like, it's overvalued. This car doesn't make any sense. She listened to me and she goes, do it anyway. And 35X, right? Yay. She did it. And so,
well, we should be interviewing her.
Right. Yeah. And I was like, why'd you do? She's like, I don't know. I just liked it. So if you have that gut feel of just I don't know, there's something here, just size appropriately, and then get ready if your money gets stuck, if it goes away, just be ready for those 2 things. If you're going to get into an investment, and then if you're going bigger, just get more confidence that that's not going to be the case, and size appropriately. If your money does get stuck, but it makes you a bunch of money, and you're going to have to make lifestyle adjustments, or there's business opportunity costs. Just try to think through those things, and plan that way. I feel like the Warren Buffett, have that 10-year plan, have a bunch of liquidity plans between now and that 10 years, but just say, what if, I like this. Like, if you really want to go strong and significantly into this, like, are these long-term partners? Is this something I want to be in? And if so, yep, I'm gonna lean into that. And this is a place I want to be. That gut feel is really important also.
So describe your ideal investor. What I'm getting at really, I'm not looking for like the biggest check or anything like that. What I'm really looking, I think, at is who belongs investing in this type of in alternative investments. I think that's probably the real question.
Along the lines of, it's people that want to partner and move through the journey with you, that understand the value, that appreciate the value in the work, and that can, for us, and that can clearly understand, kind of the field, for instance, right? And so, I'll describe. So there are a few different versions of this. One is, so we have sophisticated family office investors that invest with us, that they're super sophisticated. They understand the ins, the outs, and they come in big with us. And they also understand, how to look at things, and that change doesn't mean that it's a problem. Change means there's a change. Right. It's the people that can understand and have that discernment. And there's the sophisticated family that can look at the field and do the analytics and say, oh, I see what's going on, ask questions, and they have experience in this. Then another one I'll describe. So there's, without getting too deep, but my wife would be okay with me sharing this. So there's a surgeon that's a big investor with us. And so a couple of years ago, my wife had surgery. It was awful. It was the third or fourth surgery. It was scary, life-threatening. And so this guy said, bring her to me. So he jumped in, and right before he did that, we'd already been through some bad experiences. That, not her fault. It was an emergency thing, went bad. And he was like, bring her to me. And if you don't bring her to me, bring her somebody like me. And he gave his reason. So asked her, she decided to go to him. Before the surgery, I was like, hey man, listen, this doesn't go right. I believe I'm in the right spot, and I want you to be at peace. Just do everything you can to give us, to give us the best outcome. And if it's not you, I didn't think it wasn't supposed to go that way. So I said that to him. He went beautifully. She's amazing, super healthy. We just had a kid, but incredible, right? So it came out awesome. He came after, he was like, I'm not going to cuss. He was like, geez, man, wow.
We cuss on the Me Plus Ultra.
He was like, fuck, man. And he was like, that really, he was like, I go do this every day, and it's what I do. He was like, I felt some weight with that, but it wasn't bad, but oh, wow. And I was like, hey man, we prayed on it, and I just want you to know your decision. We're good with it. Wouldn't rather be in any other hands. So that's it. And then, so he, now as an investor, he came back at me like that. He was like, hey man, I want you to know, said a similar thing, because we have a significant amount of his livelihood with us. Right. And I was like, wow, when you put it like that, man, it's that's the type of investor that's a perfect investor to us, is somebody that gets, they understand we're the place to be. They have confidence in us in the short and the long term.
How many of them say they're good and understand the risk, and then when the risk hits, they're like, wait a minute.
That's an interesting thing that you say that, Scott. So being, having a significant amount of capital invest in people, you see multiple dimensions of the same person, right? And so it's really interesting. Sometimes it depends on what's going on in their lives and how it relates to that. For some people, other people, there's a different ethos to the way that they look at things. And, being a business, it's like being a business partner with somebody. So the right investor for us is somebody that understands and is a great business partner, and is in for the success together and all that's required to reach that success.
Yeah.
And so, we've all worked with people. Sometimes there's constructive conflict. There's dragging them, kicking and screaming. There's people read something and they, we have the gamut. We're invitation only, and we do a really good job. But we'll have somebody that'll see a newspaper article and they'll, what's going on. But I feel like the signal versus noise. We want people that are going to that value signal and value us being on signal versus noise, and understand who they are in that situation. And so the awareness of who they are. So I'll have people come and be like, hey man, I know I'm being noise right now, but you got to help me. I love that investor. That's somebody for us, right? They at least they understand that. And I'm like, you're not, no,
Am I signal or noise?
You're somehow, yeah. Somehow you're signal, Scott, in a very you type.
In a very noisy way.
And yeah, that's right. You have this density of signal somehow wrapped in. No. Love working with you. Your strategic view is special.
Final question for you. What's the dumbest thing that you've watched a smart person do in one of these?
In an investment, you mean?
Yeah.
What is the?
Hopefully, it's not. You're not going to say something that I've done.
No, I guess they're overconfidence. So I guess there's a top three. Litigation, number one, is sometimes it's a tool. It's important, but I watched a hostile takeover attempt, and it was a really smart person doing three things. They were overconfident, didn't understand the business model, litigation, and bet on the wrong team. And so that culminated in just waste and pain, and ultimately a great outcome for us, an apology from them. But that's my top. That's the top list. It was 9 years ago.
Yeah.
It was a hostile takeover attempt of a company, and it was based on overconfidence, and overconfidence in two ways: their ability to operate, and then their ability to win quickly in a legal battle. Yeah. Which the latter, I don't think there is such a thing. And then number one is so that's probably the dumbest thing I've seen a smart person. And now define smart, right? I'm talking somebody with a significant amount of resources and could pass a test. Would I call them smart? They were not emotionally intelligent. They were very intelligent from like an IQ standpoint, not from an EQ standpoint. So I guess that would be watching high IQ, be dumb on the EQ, or do something dumb on the EQ side that really played out poorly for them.
What I love about all this is, I try to teach, sometimes I preach about getting in the right rooms. And I'm very fortunate over the last 3 to 5 years to meet incredible people. You're being one of them. But, I met you through another close associate in Claudio Gambin and with GFG Solutions. But it's just an example. If I would have stayed in all the rooms that I was staying in, I would have never met you guys. And lo and behold, and what's great is, since I've met you, I've been introduced to so many other incredible people. It's just like a spider web, right? It just keeps growing out.
To me, it's law of attraction. It's it's age old. You are who you run with, right? Yeah. And you get to choose friends or the family. You get to choose, and the ecosystems you get to choose. And so it's choosing wisely there. And then if it's truly a match, that's going to expand and grow.
Yeah.
That's it. And you've been great for us with that too, Scott. When I was, I can talk about another really smart people doing something dumb if I can.
All right. Yeah.
Involving bourbon and cigars. So I have some both high EQ and IQ. I was like, I came back from Arizona and I was like, this place is amazing. And then I took the next agenda and everything, and they looked at it and they were comparing it like with a McKinsey conference, and they were like, I don't know, John, the content. And I was like, no, you missed. There's something special here. And so like the analyst in our group was like, I don't know, there's so much better content out there. And I was like, we're going, and you're going. And we came, and it's been, and it is great content, by the way. And now they're starting to see other dimensions of things that are super valuable. It's not all about just the precision analytics at that. It's about things that are durable and truly valuable. And I think that's something that Me Plus Ultra does incredibly well.
You know what's funny is when we started this thing, you have a business reason you would start something like this, right? And this is back when it was just the event, not with Business Bourbon Cigars, and not Me Plus Ultra as a group. None of the opportunities and none of the good that's come out of this have been a result of the initial intent. All the great stuff that has come has happened organically, that was not planned, and I would have never seen coming. And by the way, it's like 20 times bigger than anything that could have come from just simple transactions, from a transactional type mindset. And it's been, incredible. I could go 20 people deep of high level people I've met, that if I had not met you, and I'm not saying you even introduced us directly, but if I had not met you, those 20 people wouldn't be in my life today. And it's unbelievable.
And to me, I can distill. It's taken me a while because I've been really curious about it. Because people ask me in a similar way, they're like, "What do you get out of that play? Why do you love it?" So I'm like, "It's a good question, Scott." And they're like, And so, what truly though, joking aside, what it is, and it's if the people are valuable that are in that room, what you cultivate is introspection. People, you demand that people look inside and everything they've got, and call them to the table to take everything they've got and produce for them and their business, with people around them. But it's really that and that's what I told my team. I was like, if you're valuable at all, then you need to go to this, because it's really a meditation. What you host is like a meditation and a process to look inside, come out with it, test with people in and outside of industry. And it's a powerful and valuable thing. And obviously it carries, to your point. It's this interesting ecosystem that now, like the 7 degrees of, there used to be the 7 degrees of Kevin Bacon. I've now got the 7 degrees of Scott Joseph, and they're all good.
I was thinking about this today, but because someone asked me, well, what makes your group different or better than this group or that group? And I started giving these answers. So funny. We can always identify when someone's messing up their elevator thing, but you do it yourself, but I hear it coming out of my mouth. And I said, well, you know what it really is? I think we're more of an identity incubator more than anything else. It's almost like you're lucky if you've realized that whoever you are at this point is only going to get the company to where it's at. In other words, if you need to scale your company and you're looking to grow and really blow it out of the water, there's 0% chance you're going to do it as the person you are today. You have to become somebody different, and you have to become the person that is required to lead that company. And the person today isn't there, right? And may not even have the connections and have the room and have the knowledge. And you have to surround yourself with people that can grow you that way. It's like you have to evolve into that person. Does that make sense?
You're demanding evolution from people when they come to that, in their way of thought and their way of movement and their way of executing in their business. Whereas a lot of people are looking for, wow, what's the best practice in this thing I'm about to go implement? And you really take people on a journey and a process. And that's what the power, I think, is in that room, why the people keep coming back and why they're enthusiastic to come back. Because you have people of means that have a lot of choices, and they choose to come across the country by these ways that you select for this 2.5-day process. That's a big, it's a big commitment, and it speaks volumes. So
I had to put April's comment up on the screen. First off, thank you for the kind word.
Yeah.
I had to put April's comment up there. April. You've met her at a couple events. John and the entire Silico team are some of the smartest, most inspiring, and just good humans that I've ever met.
Well, yeah, and again, we're where you guys started. We're people that have hit a level of success where they're financially strong but plateaued, and they're trying to figure out what do I do next and not screw up everything that I've created. Like, this is amazing, but I don't want to be capped. Like, what's next? Yeah. And then and getting perspective outside of their world and view.
Yes.
For doing that. Yeah. But naturally, I love the automotive field because naturally you're building community. Like, that's what automotive dealerships do. Like,
a lot of them need to get out of their rooms. And so, I was, and by the way, those rooms, they're still good. They're, but you got to recognize what rooms are going to do the best for you. And not only that, but when you've outgrown a room, the right room, you're delivering great insight to, you're helping grow. And at the same time, you're getting just as much back. But there are rooms that we outgrow that we stay in, and we shouldn't do that. And to your point, you've got to get out there and into these different rooms and meet a variety of people. You're just kind of all practicing the same stuff. So, all right, I've been kept you on here way too long.
Thank you. Thanks for the time. You're honored for the session, and thank you, Scott. Thanks,
buddy. I appreciate you. I look forward to seeing you here. I'm going out to see your man Matt here next week.
Good.
All right, so I'll be in DC with him, and hopefully getting some things together when he speaks about AI in October. So at the next event.
Well, cool. Thanks for the virtual room, Scott. Me Plus Ultra. Love and respect, man. Thank you.
All right, and everybody you see down there, if you want more information, you can visit. I've had this scrolling at the bottom. You can visit silicocapital.com. He's got all kinds of information on there, and obviously all the contact information if you wanted to reach him. So, all right.
Thanks.
All right. Thank you all.